This is Bill Hornbarger, Chief Investment Officer with Benjamin F. Edwards, with 3 things to watch for the week of October 30th, 2023. Well, it's a big week for investors, and probably the single biggest focus will be the Federal Open Market Committee meeting. The Fed will walk out of its 2-day meeting on Wednesday and make an announcement, and we fully expect the Fed to remain on hold to leave interest rates unchanged. But in the rhetoric, the statement accompanying the move or the non-move, so to speak, we expect the Fed to reiterate that tight financial conditions are doing some of the Fed's job for it. So things like higher bond yields, a stronger dollar, a slightly softer stock market are tightening financial conditions, and that is helping the Fed in their endeavors to cool inflation off. Looking at the futures markets, interestingly enough, the futures are indicating that the Fed has finished raising rates for this cycle, but we expect the Fed still to be relatively hawkish in their rhetoric and reiterate the fact that they're data dependent and particularly focused on bringing inflation even down farther. On the economic data front, we're going to get a lot of releases this week, particularly surrounding the jobs market. On Friday, we'll get the employment report for the month of October. Non-farm payroll is expected to be up 190,000. The unemployment rate expected to be steady at 3.8%. That's after the Fed meeting. Prior to the Fed meeting, we get some what we would consider secondary indicators on the jobs market, the ADP employment report, the employment cost index, and the JOLTS data, the job opening labor turnover survey. Strong jobs market, strong consumer spending have been some of the bright spots for the economy year to date in 2023. On the other side of the ledger, Wednesday morning, we'll get the monthly report from the Institute for Supply Management on the manufacturing survey. That's a diffusion index, so readings above 50 indicate expansion, readings below 50 indicate contraction. It's expected to be below 50, come in at 49. That would be the 12th consecutive month of contraction, and certainly an indicator that the manufacturing part of the economy is in recession. Manufacturing is about 12% of output and about 8.5% of employment in the United States. So an important part of the economy. What's really interesting about that report is typically 12 consecutive months below 50 is more consistent with a Fed that would be easing, whereas today we are still in what we would consider a tightening mode.